Welcome back to the Williams Real Estate Channel. Today we are discussing the macro market update for May 2025. To kick it off, Australian population growth continues to be strong, although is trending south, but is still, based off the latest data out there, is tracking at 340,000 net migration as of December 2024. Historically around the 200,000 mark, so demand continues to be imported from overseas, and that demand is heading mainly into New South Wales and Victoria, being Sydney, Melbourne, and the balance spread out across the other regions. But a good 60% is heading into Melbourne and Sydney, so that demand is continuing to keep pushing up demand on housing. Yields are growing. So we can see that the future years ahead for Sydney, Melbourne, in terms of price growth, looks positive, as the higher yields will eventually get capitalised into higher prices. Australian GDP remains sluggish. As of March 2025, is tracking at 1.3%. Historically is around the 2 to 3%. Other than the out of season adjustment out of COVID, where a lot of demand exploded after the lockdowns. So it is sluggish, is still remaining below the inflation rate. So that's not ideal. So essentially, Australian economy is not growing in real terms. If we look at the Australian unemployment rate, it remains tight at 4.1% as of May 2025, has trended up from the trough in 23, but is remaining tight at relatively low levels if you look at historical averages. Key thing to look is to track this. If this starts to run, it'll be a leading indicator for a downturn. So, but for now, the Australian unemployment rate remains very strong. So that is good for the market. The Australian inflation rate is trending down, and the RBA today made note that CPI indicators suggest that it is still trending down, but is looking more stronger than initially expected. The RBA today met and maintained the cash rate at 3.85%. Their main remarks out of their statement today was that inflation continues to moderate towards the 2 to 3% target, but CPI indicators suggest slightly stronger than expected over June. The uncertainty around US tariffs remains unknown. However, the markets have priced in a rebound, suggesting that the extreme tariffs may not actually really be materialized and will be more moderate in nature. Domestic demand appears to be recovering as real household incomes continue to increase. The unemployment rate remains very low and tight. The board is waiting on further data to be released over July, which will indicate how the economy has tracked June to date for the second quarter. So they decide to maintain the cash rate on hold until further data is obtained to get a better indication of how we are tracking. The board published a vote today. 6 were in favour and 3 were opposed the cash rate decision. As of the 8th of July 2025, the next update from the RBA is due for the 12th of August 2025. US tariffs are due to apply as of the 9th of July. Albanese doesn't seem to have been able to get Trump on the phone to cut a deal or negotiate. So it looks to be 10% tariffs for Australia. Fingers crossed we don't get any higher than that. Essentially, the markets that will feel the most pain out of the US tariffs will be the beef agriculture industry, as less than 2% of Australian GDP is exported to the US, which is mainly comprising of beef exports. So the 10% tariff will need to either get priced into those exports to the US, or I'm sure they'll find alternative markets such as in Southeast Asia and in China to maintain a strong demand for our beef. The United States GDP growth for Q1 recorded a 0.5% decline. So we'll track this closely. If this is backed up in Q2, that will be a technical recession, probably just a slight pullback like what was experienced in 2022, as we are not due for the next downturn for the next year and a half, 2 years until we head into 2027. However, we like to track the US as the US leads the land markets and Australia typically trails 6 to 12 months behind. The US has also a tight labor market tracking at 4.1% as of June. Has started to trend up from the trough in 2023, but is still low in historical averages at 4.1. The United States inflation rate ticked up over May from 2.3% to 2.4%. The US has a target of 2%. They don't have a band like in Australia of 2 to 3%. So it'll be interesting to see how this all pans out. I know Trump has been harping on about trying to get the Federal Reserve to drop the cash rate from 4.5%, as they are holding it stubbornly and they're not looking to drop it, as the Federal Reserve is concerned around the inflation rebounding, which looks to have come off slightly last month. Trump is demanding rates to be at 1 to 2%. Obviously, he's a real estate guy. He wants to refinance his debts, also refinance the debts that the US government is holding. They've got about 36 trillion in debt, which is due to be refinanced. So he wants to refinance that at a lower rate to save costs on interest. So the Fed is sticking to their guns. Jerome Powell is remaining concerned over a rebound in inflation, and Trump is lining up a replacement for Jerome Powell as his term is due to be up as of May 2026, and Trump will be replacing him with a puppet who will ultimately drop rates. And as you'll know, come 26, we'll be entering peak land market, and you can imagine what will happen if they start aggressively dropping rates coming into the final boom years of the land market. Stock markets are already pricing in future gains. It's a leading indicator for future gains in the property market as well. They are all close to, if not at, all-time highs after rebounding over the last April, May spook from the Trump tariffs that were released. But we weren't due. The markets are not due for a significant downturn, hence why they've since recovered and will probably do strong over the next course of this year in 2025. Come 26 could be hitting its limits in the stock markets, and the risks could be more so for the downside in the years ahead. DR Horton is a land and property developer, house and land package type of developer in the US, the largest in the US. We like to track this share price as it is a leading indicator for the next land-driven downturn, as historically DR Horton lost 66% over 26 months to October 2007 before the entire stock market topped out and then went through the GFC. So we're tracking this as of the peak in September 2024. This same company share price has lost 32% over 9 months. So halfway there. It looks to have kicked up a little bit over the last month. but I'm sure this is just a dead cat bounce and it will continue to keep trending down. And once we hit close to 50, 60%, that could be an indicator that the overall stock markets have topped out. Keep a good track of this because it is a great indicator for the next turn in the share markets. As you know, we use the 18-year land cycle framework as our framework to work out where we sit in the market. And then from that, we peel back layers to work out which best market to deploy capital into to buy property, because there is not one property market. Every market, metro, region, type of property, unit, villa, townhouse, house, blocks of units, commercial, vacant land, all runs its own race as the cycle plays out. So you have to move and shift as the cycle plays out in order to continue to get the gain, so you can continue to keep building a sustainable portfolio over the long term and prevent you getting caught up in all the fuss and the fear of missing out, like what most of the mainstream are doing now, and buying up into Brisbane, Perth, and Adelaide, Darwin, and their respective regions. As if you are looking to do that, you will learn the hard way in the coming years when the major land-driven downturn sets in. Those markets will get hammered. The ripple effect will come back to Sydney, Melbourne, and Sydney, Melbourne will be pumping again, just like what they did from around 2007, 8 and onwards in the recovery of the current cycle, which will happen in the next cycle. That's a framework, as you can see, where we're heading. Final euphoria over the next 12 to 18 months. Be sure to see the craziness all play out, but be cautious with your investments. Don't get carried away with the herd. There's always plenty of time to buy property, and it's never a good idea to rush into overheated markets towards the tail end with all the fear of missing out and buy at auctions and overpay, because you end up holding it for many years with next to no equity, and even in a worse position, the banks might try and recall their loans when the market turns. So buyers beware. There's many punters out there these days. If that helps, if you resonate with my thoughts, my strategy, shoot me an email. Happy to chat, get on a call, see where you're at, see how your properties are performing and how we may be able to work together in the future years ahead to capitalize on the next wave that is just around the corner, provide you're buying in the right market, in the right asset class, and paying the right price. Until next time, thanks for watching.